Welcome to this explainer. If you've got a macroeconomics exam looming and you're staring at a massive mountain of national accounts data feeling totally overwhelmed, well, you're in exactly the right place. We're going to dive straight into a highly structured review of national accounts aggregates. My goal today? To distill all the crucial data from our source texts so you can absolutely crush that upcoming test. We aren't leaving any relevant information behind. So grab your notepad and let's get into it.
Here's our game plan. First, core concepts like GDP and NDP. Then, the three measurement approaches, unpacking expenditure components, stepping down the income ladder, and finally those crucial adjustments and prices.
All right, part one, core concepts, GDP and NDP. Let's lay the absolute foundation.
The big one, gross domestic product. The crucial takeaway here is that GDP is fundamentally built by adding up the gross value added from every single producer unit within an economic territory. Now here's a detail you'll want to highlight for the exam. This includes all resident producer units for a given reference period, completely regardless of their nationality. Basically, if they operate within the economic territory for a year or more, their value added counts towards the GDP. Simple as that.
Now, this brings us to the production boundary. And trust me, examiners absolutely love to test you on this. You need to know exactly what counts as production and what doesn't. Look at the inclusions. If you grow agricultural products for your own consumption, or if you own and live in a rental property, the imputed value is totally included. But pay very close attention to the exclusions. Household services, things like cooking, cleaning, or minding children done by household members for their own family, those fall strictly outside the production boundary. They will try to trick you with that on the test, so don't fall for it.
Moving on to our next core concept, transitioning from a gross measurement to a net measurement. In national accounts, the inputs consumed during the actual production process are called intermediate consumption. But the wear and tear, the actual reduction in the value of the fixed capital itself during production, that's called the consumption of fixed capital, or CFC. So whenever you need to calculate net domestic product from GDP, you absolutely have to subtract this CFC. Gross minus CFC equals net. Memorize that.
Okay, moving right along to section 2, the three measurement approaches.
Think of the economy as a completely closed, circular loop. It's really elegant when you think about it. It all starts at the production stage. Units engage capital and labor to turn out goods and services. This production generates money, which is then distributed right back as income to employees and entrepreneurs. And finally, that income is utilized as expenditure to buy those goods or acquire more capital. Because it's a closed loop, GDP is identical whether you measure it at the point of production, the point of income generation, or the point of final utilization. It all balances out.
Let's zoom in on that last stage. Section 3, unpacking the expenditure components.
Looking closely at the total availability of goods leads us straight to a really critical formula. If you take the total production plus imports and then subtract intermediate consumption, you are left with final utilization. This gives us the famous expenditure equation. GDP equals final consumption plus gross fixed capital formation plus change in stock plus net exports. Write it down, circle it, know it. This is the absolute bedrock of the expenditure approach.
Now, for your exam, the devil is always in the details, right? So you have to remember these specific nuances. First up, under private final consumption expenditure, the purchase of durable goods like cars or TVs totally counts. But land and residential buildings? Nope. Those actually fall under capital formation. Second, government consumption includes non-market collective services. Think defense and public health. Because the government obviously isn't selling these services at market rates, they're simply valued by adding up the actual cost the government spent to produce them.
All right, we've covered the expenditure side. Now for section 4, stepping down the income ladder.
We're going to move from broad national income all the way down to the actual cash in your wallet. Keep in mind that national income is strictly the sum of primary incomes. We're talking about compensation of employees, operating surplus, and mixed income of the self-employed. To get the gross national income, you just take that domestic income and add the net income received from abroad. So that includes things like the wages of residents working overseas or foreign property income.
Now, make a huge star next to this in your notes. You must distinguish primary income from transfer payments. Transfer payments are things like old age pensions, education grants, unemployment benefits, or even gifts. Because absolutely no goods or current services are provided in exchange for this money, they are considered secondary incomes. And because of that, they are strictly excluded from primary national income. No exceptions.
Let's actually walk down this income ladder step by step. It's like a giant puzzle. Starting with national income, we strip away the government's share of property income and add in those transfer payments we just talked about. That gives us private income. Next, we strip away corporate retained earnings and corporate taxes. That leaves us with personal income, which is the actual current income received by persons. Finally, we take out your personal direct taxes. And what is left? Your personal disposable income. That is the actual, usable money available in your hands for spending. So what actually happens to that disposable income? Well, whatever isn't utilized for final household consumption simply becomes savings. Our source text explicitly defines saving as the excess of current income over current expenditure. And here is a brilliant little macroeconomic identity you should definitely memorize. In a closed economy, total savings exactly equals capital formation during the year.
We're in the home stretch. Section 5, Crucial Adjustments and Prices.
If you master these adjustments, you are going to master your exam. First up is understanding the difference between factor cost and market prices. Factor cost is the actual raw cost paid to the factors of production, your labor, your capital, and so on. But think about when you go to the store. The price you pay at the register includes indirect taxes like sales tax or excise duties, and it might even be reduced by government subsidies. So to transition from factor cost to market prices, you have to add those indirect taxes and subtract any subsidies.
Similarly, you will absolutely 100% be tested on the difference between current prices and constant prices. Current prices, also known as nominal values, measure the economy using today's prices. That means the effects of inflation are baked right in. Constant prices, or real values, completely eliminate the effect of inflation by recalculating everything using the prices from a fixed base year.
Which brings us to a classic, high-stakes exam question. Think about those two pricing models we just covered. If a test asks you, which estimate gives a proper measure of the overall real increase in production and the true economic welfare of the country's people? What are you going to say?
The answer is national income at constant prices, otherwise known as real GDP. The source material is crystal clear on this. Because it strips away all that noise from inflation, it reveals the true variations in productivity and structural growth. It's literally the only way to accurately judge the commonwealth of the people. And with this ladder of concepts memorized, you've got everything you need to conquer your exam. But before we wrap up this explainer, ask yourself this. When you see GDP growth reported on the evening news tonight, are they giving you the current prices or the constant ones? Knowing the difference truly changes everything.